China has responded to Trump's import taxes with a 34% retaliatory tariff on all U.S. goods entering China. One industry that could be hit hard is farming.
In April 2025, a cargo ship loaded with U.S. soybeans was halfway across the Pacific when it received an abrupt rerouting order, because apparently China decided to cancel all U.S. soybean shipments effective immediately. By noon, 2.4 million tons of soybeans were nonchalantly diverted to Brazil, and by sundown, a staggering $1.1 billion in American farm contracts had simply evaporated. This wasn't some clumsy trade war tantrum. It was a controlled demolition, with soybeans just the fuse. 40 ships were rerouted, and a multi-billion-dollar trade route snapped like a brittle twig under pressure. This wasn't a mere hiccup in trade logistics. It was a deliberate stress test of U.S. economic resilience. And guess what? America cracked first. While the Pentagon and Wall Street scrambled to comprehend the fallout, U.S. farmers were left holding the bag as unsold inventories surged 13%, prices plunged 8.2%, and farm incomes faced an 18% nosedive. Meanwhile, Brazil, backed by years of Chinese investments in ports and railways, smoothly stepped in to supply 70% of China's soybean needs. No tariffs, no drama. The timing was surgical. China pulled the rug out during America's peak shipping season, triggering a cascading sell-off and exposing just how fragile the U.S. agricultural dominance really is. Bloomberg was the first to reveal that China unexpectedly canceled soybean orders from 3 major U.S. exporters, Cargill, ADM, and Bunge, citing strategic shifts in their procurement approach. By the end of that same week, Chinese buyers had secured roughly 2.44 million metric tons of soybeans from Brazil, amounting to more than $1.1 billion in value, according to customs figures monitored by S&P Global. This volume accounted for nearly 1/3 of China's average monthly soybean imports. While Beijing did not officially characterize the cancellations as retaliatory, the timing was highly suggestive. The move occurred within 48 hours, following President Trump's announcement of new tariffs targeting $90 billion worth of Chinese goods. Economists at Rainbow Bank warned that this could represent a deliberate effort to permanently reduce China's dependence on U.S. agricultural exports. The critical question remains whether this is a short-term tactical response or the beginning of a fundamental restructuring of global food supply chains. The consequences for the U.S. agricultural sector were immediate and measurable. The USDA's April 2025 soybean report documented a 13% increase in unsold soybean inventories domestically, pushing storage levels to their highest point for April since 2019. Concurrently, soybean prices on the Chicago Board of Trade plunged 8.2% within a matter of days, wiping out over $470 million in commodity value in just 1 week. In Iowa, grower sentiment cratered as farmers found themselves abruptly locked out of their largest market mid-season. "We've been shut out with zero contingency plans," lamented Matt Dunn, a fourth-generation farmer in Des Moines, in a Wall Street Journal interview. "This isn't a trade dispute anymore, it's economic isolation." The American Soybean Association projected that China's withdrawal could carve up to 18% from farm incomes this quarter alone, a brutal blow to an industry already reeling from the Trump administration's 20% tariffs on Chinese electronics, metals, and EV components announced March 10th. The tariffs, intended to pressure Beijing ahead of trade talks, backfired spectacularly. Instead of folding, China retaliated by targeting one of the few U.S. exports it still pretended to need: agriculture. Soybeans, of all things, a crop that generated $14.3 billion in exports to China in 2024, making it America's single largest bilateral trade lifeline. China isn't just hitting back, it's hitting Trump's base where it actually hurts: rural voters and farm states, sneered Chad Bown, a senior fellow at the Peterson Institute, during a CNBC segment on April 2nd. The irony? While Trump's team wagered on soybeans as a bargaining chip, China had spent years quietly diversifying its supply chains. Now, U.S. farmers are left holding mountains of unsold beans, and the administration's tough-on-China posturing looks more like a strategic misfire. The Midwest, once a bastion of political loyalty, now faces a reckoning. When your trade policy hinges on a single crop and a single customer, maybe don't poke the dragon with tariffs unless you're ready to watch your own house burn. The USDA has confirmed that farmers in 11 Midwest states now face moderate to high risks of insolvency due to canceled forward contracts amid mounting trade pressures. The escalating trade conflict is rapidly turning into a significant political liability for the Trump administration. Yet, this issue goes beyond soybeans. It reflects a broader strategic realignment in global agriculture. Brazil's ability to quickly fill the void left by the U.S. was no coincidence. From 2020 to 2024, Brazil expanded its soybean acreage by 21%, supported by over $11.2 billion in agricultural infrastructure investments. Chinese state-owned banks financed key grain terminals in Santos, expanded freight corridors from Mato Grosso, and co-funded the Ferrovia Railway, which cut internal transport times by 42%, according to a February 2025 Reuters report. This infrastructure buildup laid the foundation for China's decisive pivot. In early 2025, Brazil exported a record 15.7 million tons of soybeans in March alone, with nearly 75% destined for China, the highest monthly volume ever shipped to the country. Bloomberg Intelligence now reports Brazil can supply up to 70% of China's annual soybean demand, benefiting from fewer GMO restrictions, looser environmental regulations, and stronger bilateral trade protections under BRICS agreements. Brazil's soybean production is projected to reach 165 million tons in the 2025/2026 harvest, with exports expected to hit 110 million tons, a substantial portion of which will go to China. This deepening trade partnership was further solidified during Brazilian President Lula da Silva's recent state visit to China, which resulted in multiple cooperation agreements across agriculture, technology, and finance. China's strategic diversification of soybean sources, combined with Brazil's competitive pricing and expanded capacity, signals a permanent shift. The U.S. is not merely being priced out, it is being systematically planned out of a critical segment of the global food supply chain. By pulling out during this critical shipping season, China triggered a cascading sell-off that hammered both price and volume. Remarkably, Brazil's harvest wasn't even at full capacity yet, but China willingly paid premiums reportedly ranging from $14 to $22 more per ton, according to traders cited by the Financial Times. Why overpay? Short-term losses can yield long-term control, argued Minyu, a trade analyst with China's Ministry of Commerce. This wasn't merely about soybeans, it was about leverage. China officially cited phytosanitary concerns, pointing to alleged fungal residue and pesticide traces in U.S. soybean shipments. Interestingly, while China's U.S. soybean imports rose 12% in March 2025 compared to the previous year, largely due to shipments secured in late 2024 amid fears of renewed trade tensions, the overall trend favors Brazil. Brazil is poised to dominate the market as its harvest season ramps up, with exports reaching a record 15.7 million tons in March alone, nearly 3/4 of which were destined for China. This surge comes despite Brazil's shipments falling 69% in March compared to last year, a decline attributed to harvest delays. Analysts forecast China's soybean imports could hit a record 31.3 million tons in the April-June quarter, driven by Brazil's exceptional crop. Brazil's ability to supply up to 70% of China's annual soybean demand, combined with fewer GMO restrictions, looser environmental standards, and stronger trade protections under BRICS agreements, underscores the permanent nature of this shift. Meanwhile, U.S. soybean farmers continue to face significant challenges. Despite a recent tariff truce reducing Chinese tariffs on U.S. soy from 125% to 10%, American producers argue the relief is insufficient. Brazil's competitive pricing and abundant supplies from a record harvest keep U.S. soy at a disadvantage. As Caleb Ragland of the American Soybean Association noted, products sourced from rivals in Brazil and Argentina do not carry this additional expense. What was once America's largest bilateral agricultural export to China, valued at $14.3 billion in 2024, is now at risk of being permanently eclipsed. China's strategic diversification of soybean sources signals a broader realignment in global agricultural trade, with Brazil firmly positioned as the dominant supplier.